Ladies and gentlemen, good day and welcome to Renaissance Global Limited Q1FY22 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anup Pujari from CDR India. Thank you, and over to you, Mr. Pujari.
Thank you. Good evening, everyone, and thank you for joining us on Renaissance Global's Q1 FY22 earnings conference call. We have with us today Mr. Sumit Shah, Vice Chairman, and Mr. Hitesh Shah, Managing Director of the company. We would like to begin the call with brief opening remarks from the management, following which we'll have the forum open for an interactive question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the results presentation shared with you earlier. I would now like to invite Sumit to make his opening remarks.
Good evening, everyone. On behalf of Renaissance Global, I extend a warm welcome to everyone to this earnings conference call. I trust you and your families are safe and healthy. I will begin the call by providing you a quick overview of the company's operational and business highlights for the quarter, following which Hitesh will take you through the financial performance. We are pleased to share that we have started the new fiscal year on a positive note, with another quarter of consistent and solid performance, improved recovery, and further opening up of our key markets in the US and Canada translated into healthy demand and consumption during the quarter. We are seeing wider vaccine coverage, improving macros and sentiments, normalizing across the key geographies, which we believe will further strengthen demand momentum going forward. Our strategy is to grow our business through licensed brands and our own brand globally. We plan to scale this division through distribution through our retail partners and direct-to-consumer. Due to the structural shift within the jewelry industry towards brands, we see a decades-long opportunity for growth in this division. We are also investing in our own brands, Jewelry and Made For You, to create value. We see these brands as a means of differentiation in a very large global opportunity. We believe that the branded division will help improve operating margins meaningfully for years to come. We plan to invest in this division, generating meaningful cash flow and growth for our shareholders. In the last quarter, branded jewelry accounted for 24% of our total studded jewelry sales. Our strategy is to continue to grow the share of this business. The company is focused on branded jewelry through exclusive licensing arrangements with Disney, Hallmark, and our own brands. There are meaningful and significant discussions that are ongoing for new licenses that would support our growth for years to come. We would announce them at an appropriate time. We have now commenced operations in China by shipping our first order to LFX in Q1 '22. Renaissance has planned an omni-channel approach for the Chinese market. We are very excited about the growth of our direct-to-consumer business. E-commerce adoption accelerated during COVID provides long-term momentum for this division. Our direct-to-consumer business through our newly launched websites has shown robust growth during the year. Our Q1 FY22 direct-to-consumer revenues were 25 crores with an EBITDA margin of 18.1%. Based on our estimate of the quarter's contribution to annual sales, we are at an annual run rate of 125 crores. We expect the direct-to-consumer business margins to improve going forward to the 20 to 22% range. This 125 crore direct-to-consumer business has been built from zero in a matter of 18 months. We started our first direct-to-consumer website in February of 2020. In May 2021, we launched our sixth direct-to-consumer website for Hallmark Diamonds. Consumer response has been very encouraging for the newly launched website of Hallmark Diamonds. Overall, we have delivered an encouraging set of results in the quarter I have never been more optimistic about the opportunity we see in front of us. The branded jewelry segment and the direct-to-consumer division have opened up many growth opportunities for us across markets, and we look forward to delivering healthy performance with improved profitability in the years ahead. Now, I'd like to turn the call over to Mr. Hitesh Shah to discuss our financial performance.
Thank you, Sumit. Good evening, everyone. The company during Q1 of FY22 reported a total income of rupees 419 crores against rupees 189 crores during the corresponding quarter of the last financial year. This is a growth of 121% year-over-year. The performance was driven by increased offtake in our own branded jewelry segment, robust contribution from the direct-to-consumer business, as well as a lower base in the corresponding quarter of last year. With effect from 1st April 2021, the company has renegotiated terms with most customers across its plain gold division, due to which the company is now recognizing only making charges as revenues for this business. This will meaningfully reduce the reported revenues of the gold division without impacting EBITDA of this division. On a like-to-like basis, our revenue growth would have stood at 138% against the reported growth of 121%. Our EBITDA stood at rupees 41 crores, while our profit after tax stood at rupees 24 crores. We expect profit after tax for FY22 to grow between 18 to 22% over our FY20 profit after tax, which would be approximately 130 to 140% growth as compared to FY21 PAT. The company has managed to lower its net debt to equity levels to 0.25 in June 2021 from 0.45 as on June 2020. Cash and bank balances and current investments as on 30th June 2021 are at rupees 256 crores. The company's trailing 12-month return on equity stands at 10.9%, while our trailing 12-month core return on equity stands at 13%. Our long-term goal is to be at zero net debt over the next 3 years. In terms of geographic distribution of sales in Q1 of FY22, USA contributed around 66% to overall revenues, with 17% coming from Middle East. In terms of product category, studded jewelry contributed to 93% of the revenue, with the balance contribution coming from the plain gold jewelry segment. Thank you very much for your kind attention. Now the floor is open for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. Anyone who wishes to ask a question may press star and 1. Participants, you may press star and 1 to ask a question. The first question is from the line of Parag from Kingstone Capital. Please go ahead.
Hi, this is Parag from Knightstone Capital. Sumit, could you talk about the working capital of the 3 segments separately? How much is the inventory and receivables for your plain gold business, your branded business, and customer brand business?
Sure. So, I think the working capital cycle varies a little bit by division. We haven't, run the numbers in detail in terms of the inventory and the receivables by division. But to give you a broad context, the plain gold jewelry division would have essentially a 15 to 20 day working capital cycle. So essentially, the working capital for that business is relatively small. I think the working capital cycle for the studded jewelry part again is divided into two parts. The direct to consumer business has obviously zero receivables and lower working capital and inventory cycle because gross margins are large, and even if we carry 3 to 4 months of inventory, it works out to between 15 to 20% of sales as working capital on the direct to consumer side. On the wholesale side, I would say in general the working capital cycle is better on the licensed brands and the branded jewelry as compared to the customer brands, where there is lower rates of consignment and or testing that is done by the retailers. So, if I were to sort of tier the studded jewelry segment, obviously the direct to consumer bit would have the best working capital cycle, followed by the licensed brands that are distributed through retailers, and the highest working capital being for the customer brand segment.
And for customer brand segment, approximately how much would the receivables be, and how much inventory do you generally keep?
So I would say that our receivables average are between 30 to 90 days, and with the average being closer to 60. For the plain gold would be zero, and plain gold would be very short, and direct to consumer would be zero. Sorry.
Thank you.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Kalpesh Parekh from JSN Financial. Please go ahead.
Yes, sir. Hi, good evening. I have one question. Particularly, sir, you are giving a lot of trust on branded jewelry segment. So what steps we are taking in this direction? How we can step up furthermore the contribution of branded jewelry? And a few years down the line, how much you are expecting branded jewelry as a percentage contribution?
So on the branded jewelry side, since we have healthier margins, between 13 and 20%, I mean, the absolute endeavor of the company and the focus of the company is to grow the branded jewelry segment. This includes deeper penetration of current brands. If I were to tier the various brands that we have, Enchanted Disney Fine Jewelry, which is the oldest brand of the company, is the more mature brand with wider distribution to over 2,500 stores. The newer brands of the company, Disney Treasures and Hallmark, have lower distribution through various retail stores. So, our efforts really are on the wholesale side to increase penetration in the US as well as internationally for the newer brands that we currently have. And the direct to consumer side also, we have a dedicated digital team which has done a fantastic job of growing our direct to consumer revenue year over year, and we see that trend continue going forward. In addition to the existing brands, we have been having very meaningful conversations with newer potential brands that we plan to announce in the months to come, which would also provide additional impetus to our growth for the branded jewelry segment. So, the company is fully aligned to growing the branded segment to a larger percentage of the total, And I would say that, a medium to long-term goal would be to have the branded jewelry to be at least 50% of the studded jewelry share and, go from there.
But in that scenario, what type of margins we should visualize? We have already seen dramatic good improvement in this quarter. So what type of margins as an investor we should expect, that we will do it in next couple of years?
So I would say that, broadly, as the mix changes, the margins will go up, right? Currently, we are, sort of in that 10% range or so. So as we see the share of the branded jewelry segment go up, which is basically, in that 13 to 20% range, I mean, we should be able to get to, between 10 and 15%, depending on the penetration of the branded jewelry segment.
And my second question was on this entry into mainland China, basically. So, why China, and what type of opportunities we are visualizing in China? This will be branded segment, right?
Yeah. So currently, our entry into China is, through our brand Enchanted Disney Fine Jewelry. And there is obviously a great affinity for some iconic US brands in China. We worked with Disney to identify markets where the brand would be relevant, and based on the success that Disney saw with the opening of their Disney World in Shanghai, we identified that as a key market. It is one of the largest jewelry markets in the world. So structurally, we think it's a very big opportunity. However, in China, we plan to stay focused on the branded jewelry segment and, not sort of customer brands or generic product at all.
So here, the incrementally, I think we will have a partnership or a tie-up with this Chinese giant Lao Feng Zhang, LFX, or how it will be. We will use them as our channel partner, or how we will try to leverage on this Chinese giant?
Yeah. So LFX is basically the second largest retailer of jewelry in China. We've got a exclusivity arrangement with them for a 3-year period, whereby all brick and mortar distribution will be done through their stores. In addition to distributing product through their retail stores, we are in the process of setting up our direct-to-consumer business in China as well. So it will be sort of a dual approach, whereby the distribution through retail stores will be done by LFX, and we will also be selling direct-to-consumer initially by listing our products through Tmall, which is a division of Alibaba.
Okay, fair enough, sir. Wish you all the best.
Thank you.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Amit Doshi from Care Portfolio Management Service. Please go ahead.
Yeah, thank you. So these tie-ups with this Disney, Star Wars, they are currently part of branded jewelry segments or customer brands? I mean, they're classified under.
So that's part of branded jewelry.
Branded jewelry. Okay. So can you just tell what kind of proportion would be between this and our own brands?
Yeah, so I think it would be about 80-20. 80% of it would be licensed brands and 20% would be our own brands.
Okay, and how does this arrangement work with these licensed brands, as in terms of designs, in terms of royalty, etc.? How does it work? If you can broadly share things.
Sure. So essentially, the licensing arrangement is obviously to utilize the intellectual property of these companies. There is sort of the designing, marketing, and distribution of the product is done entirely by our team. The role that Disney or Hallmark would play in this process is they would ensure that the product that we are creating or the marketing that we are creating does not infringe on their intellectual property in any way. So they sort of act as a gatekeepers of their brand, to ensure that the product that is being created and the marketing is in line with their IP. Other than that, all of the product design, all of the marketing and everything is done by our team.
Okay. So when you say it's an exclusive license, means so for example, for particular characters, if you have taken, so no other manufacturer would be able to kind of design on those fronts?
Yeah. So currently, it's geographical. Our arrangement for fine jewelry with Disney in certain geographies is exclusive, but the brand Enchanted Fine Jewelry worldwide is only us. So there are certain geographies in the world where Disney may have given IP, to certain other manufacturers as well. But we are sort of building on the brand of Enchanted Disney Fine Jewelry, and in the US, in the fine jewelry space, it is an exclusive arrangement.
Okay, and in terms of royalty or because everything is done by you, the designing, marketing, distribution. So how does that arrangement work?
So, royalty is obviously, something that we've not disclosed publicly. But, our royalties are relatively competitive compared to what you'd see with any licensing arrangement globally. And, I think the margins that we're sort of reporting for this segment is obviously after payment of any royalty to the license, owners of the brand.
Fair enough. And so if you were to sell, of course, the Disney jewelry, Disney branded or this Hallmark branded jewelry, of course, it would be far more easier for you. So in terms of EBITDA, in terms of margin between these two segments, like your own brands versus this Disney brands, etc. So what could be a broad difference in terms of that margin profile?
So I think they would be similar. Our own brands as well as the licensed brands, the margins would be relatively similar in the branded jewelry segment.
Oh, okay. So there, okay, fine. Okay, and this going forward, you see this proportion remaining 80-20, or what kind of proportion do you see this?
So yeah, I would say that broadly in the short term, I think that the licensed brands will be the larger share of the branded jewelry segment, because I think that there is a significant opportunity to acquire new licenses. As we have established ourselves as the go-to company in the US market in order to build a brand. I mean, for perspective, Enchanted Disney Fine Jewelry at retail is, greater than a $200 million brand at retail. I mean, obviously, because we sell through retail partners, we recognize only 1/3 of that revenue, because that's the wholesale price of the product. So having built a brand which is over $200 million in a space of 4 or 5 years, there is significant advantages to us in terms of new licenses and new IP that we can sign. So we would definitely see the license part growing fast, and I would expect the proportion of 80-20 to remain going forward as well.
Right. And also, I think if the margin profile is similar, then why, of course, developing your own brand, I'm sure it will take probably 4 years to kind of make a mark in the segment.
Yes, it's much more difficult to grow your own brand. That you're absolutely right about. And with these brands, since the IP is intellectual property already exists and they are loved consumer brands, it's relatively easy to scale those businesses compared to our own brand.
Any specific additional kind of marketing spend compared to last year you would have, or it's going to be like to like? I mean, because we are expecting huge segments, so what kind of market spend that we are targeting?
Currently, what we are doing is, we are investing significant resources as a percentage of our direct-to-consumer sales on marketing. As a broad rule of thumb, probably close to 30% of the expected sale of the direct-to-consumer segment. So I would expect our marketing spends in this year to be between 30 and 40 crores.
Okay. Fine. Okay. So when you say that okay, net debt 0. Okay, fine. Yeah. Thanks. Thank you so much. All the best.
Thank you.
Thank you very much. Participants, you may press star and 1 to ask the question. Next question is from the line of Chirag Vakharia from Bodrani Finance. Please go ahead.
Good evening, sir. What I want to understand is, in China, what is the size that you are looking at in terms of business?
So, Chirag, I think it's very difficult to sort of pinpoint the exact size because, we, since you're aware, we only shipped our first order in this quarter. The feedback that we've got from the customer is that, consumers have really loved the product and, there is plans of expanding. There are currently talks ongoing of expanding the current, 100-door test to about, 400 to 500 by Chinese New Year. So I think we're in the sort of early innings of our growth and expansion into China. I mean, for perspective, China is obviously, as large a market as the US for jewelry, and the size of the market is not the problem. It is though a competitive market. So it's something that we'll have to sort of update you in the coming quarters and years because it's a little early.
This online initiative that you are looking in China, is it with the help of LFS or you by yourself would be looking at the Chinese market?
No, we would be doing it ourselves. But we are planning to list it on Tmall. It's not going to be an independent standalone website.
Okay. And on the P&L side, I wanted to just understand employee costs and other expenditures have gone up. What we understand is you are trying to control the employee expenditure. So what should be the normal run rate both for the employee cost and other expenditure going forward?
So I think to a certain extent the employee costs are not strictly comparable year over year. As last year was a COVID quarter. However, some of the direct to consumer initiatives will require investment in talent and digital marketing and branding. So I think employee costs from what I see now are in the 6% or so range. So we would expect that to sort of that number to be at around that level going forward.
And the other expenditure, is there a one-off? I mean, it has also shot up both sequentially.
So I think the other expenditure does have a lot of variable expenditure. So when sales are higher, the other expenditure like shipping and manufacturing boxes. So there is a variable element to other expenditure as well. It's not more of a static number. So I would sort of kind of model part of it as a variable expenditure linked to sales.
Okay, sir. Thank you.
Thank you. Participants, you may press star and 1 to ask a question. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Parag Jhawar from Knightstone Capital. Please go ahead.
Hi, Sumit. Parag again. Could you give an update on Irasva? I think last quarter because of lockdown must have been impacted, but what's the longer term roadmap here in terms of number of stores rollout? And related to Irasva again, where is the revenue reported from Irasva, in which line item? Is it branded D2C or somewhere else?
Yeah, sure. So, currently the revenues of Irasva are extremely small because all three of our retail stores are in Mumbai, and as you know, in the last quarter, our stores were not not operational. It would be the revenues are reported in the branded direct to consumer segment. However, the revenues currently were not material in this quarter because of the lockdown. I think as the stores open up, we should be our goal here is really to get to back to store level profitability, which our store was operating at prior to the pandemic. We haven't seen a recovery at unit level economics at Irasva after the pandemic. So we're sort of kind of in a wait and watch mode. However, we are very optimistic that we can solve for the Indian market and be able to grow the brand. So I would say that the longer term objective would be to grow the business and make it meaningful. But realistically, I think it's a 3 to 5 year process before Irasva contributes meaningfully to the revenue and the profitability of the company.
Got it. And one clarification on the license front. So what is the duration of the license that you have got, and what is the renewal process here? Is it automatic? You'll get it renewed in your favor, or it can be given to someone else as well?
So, obviously the owners of the brand have the discretion to, at the expiry of the contract to decide to do whatever they please. However, having said that, Disney's had, like with Hasbro and Mattel, really long-term relationships and partnerships over 40 and 50 years. What I'll say about our licensing contract is they're relatively long-term, and currently at this point, we don't see any material risk of not being able to renew the licenses.
And when you say long-term, would be 10 years plus?
They are less than 10 years. It's between 5 and 10.
Thank you.
Thank you. Participants, you may press star and 1 to ask a question. Ladies and gentlemen, a reminder, you may press star and 1 to ask a question. As there are no further, the next question is from the line of Nikhil from Galaxy International. Please go ahead.
Yeah, thank you for the opportunity. Just one question. So on this Indian retail store side, what is the management thinking about this initiative actually? So it's a long-term initiative. It takes a lot of effort and it involves a lot of capital expenditure, brand building and other things. And so do you really want to go into...
Your voice is coming very muffled. May I request you to speak through the handset?
Yes, sure. Yeah, so the question is that, let's say, what is the management, let's say, view on...
Nikhil, you are sounding very far away from the phone now.
Hello?
Yeah, go ahead.
Yeah, am I audible now?
Yes, much better. Thank you.
Yeah, thank you. Okay, so my question was only related to Irasva. So basically, we are going ahead and starting this initiative, or have started this initiative with a couple of stores. But how do we actually want to grow in this business? Because it's a capital-intensive business, it takes a lot of effort, and then it's a little different from our, let's say, our business where we are primarily promoting our brand through the website and channel. So here we are having a physical presence. So just wanted to understand the thoughts on this. Thank you.
Sure. So I think that our brand Irasva is a very specific brand, meant for more for daily wear and a little bit for occasion wear. So I think that it's targeting a certain opportunity and a certain type of customer. This is not a business which is wide, trying to be everything for everyone. And broadly, if I were to tell you the capital expenditure per store, would be in the region of about 2 crores a store. And I think even if we were to do 20 stores over the next 3 to 4 years, we're talking about a capex of 40 crores or so cumulatively over that time period. I think currently our company will probably generate between 110 to 150 crores a year in terms of free cash flow. So I don't think it's very meaningful as we grow that business in terms of significant capital expenditure. I mean, we're talking about sub 10 crores a year. And, working capital is also something we are sort of looking to manage by working with, 2-time turn on the inventory. So we don't expect that to be a significant drag. However, we will be extremely disciplined about only opening stores when it makes sense from, unit economics, meaning store level profitability, return on equity, and return on capital employed at store level. So I think we're going to be prudent in our growth plans here. However, we don't expect this to be a significant drag on our free cash flow generated by the business.
Okay. No, my basic idea was that if this is not going to be very significant over the next 3 to 5 years, so do we really want to go ahead and put our energy into that? So that was the only question. Maybe there is merit in this which I am not able to understand. But that was the intent. So that was question number one. And second question, I just wanted to understand. So the licenses that we have for the brands, do we have these on a global basis? So tomorrow, if we want, we can go to Europe or Australia or some other developed world with these brands?
Yes. That's right.
Okay.
So currently, our arrangement with Enchanted is already international. So we have the license for US, Canada, UK, Middle East, as well as China. And Star Wars is currently in the US, and we're just launching Star Wars in Japan as well. So the ability does exist for us to take on additional markets in a methodical manner. And going back to your question, to relevance of Irasva, we believe that, going forward, even at a level of, I just gave you a small example of 20 stores. I think each store has the ability to generate about 20 crores in revenue. And, if we do get to that size where we're going from 20 to 100 stores, I think it is possible for this to be meaningful going forward. It's obviously small today, but, we believe that there is an opportunity in India to create a differentiator and a differentiated business model. And, we do plan to stay committed to it as well.
Okay. Just an additional question. So the geographical breakup of our let's say consumer brands would be, let's say, mostly from the US, right? So that's what my understanding is. Is there anything that you have started, let's say, or planning to start in Europe?
So Europe is a slightly more difficult market compared to the US for studded jewelry. And we do currently sell in the UK and in Europe, but it's a much smaller part of our business. Europe is effectively between 10 and 15% of our overall revenue.
Okay, sure. So that's all from my side. Thank you.
Thank you.
Thank you very much. Ladies and gentlemen, that was the last question for today. I will now hand the conference over to the management for closing comments.
Thank you. Thank you, everyone, for joining us today on our Q1 FY22 earnings call. As I mentioned earlier, we're very excited about the growth opportunity in front of us, and we look forward to seeing all of you on our next conference call. Thank you.
Thank you very much. On behalf of Renaissance Global Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.